Is Tesla a buy at 280 per share? And if you want to build indestructible generational wealth, is Tesla a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of Tesla based on their recently reported 2024 results. I think Tesla is a great long-term investment, but at 280 per share, I have a hold rating on the stock. In my research, I discovered 5 things that got me very excited and 3 red flags to watch out for with Tesla. So, what did I discover? What is my value for Tesla? And what is an ideal entry point should you decide to become a Tesla shareholder? Let's dive in and find out. In this video, I will cover Tesla's recent results and what everyone is missing, what I think about Tesla stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in Tesla stock? Why or why not? Let me know in the comments below. 2025 will be a pivotal year for Tesla as it doubles down on AI, full self-driving cars, and energy storage growth while balancing lower vehicle margins with cost efficiencies. However, higher operating expenses and CapEx may pressure short-term profitability. Let's cover the red flags first. Tesla has been forced to cut prices to remain competitive, pressuring profit margins. Tesla faces heavy competition in China despite record deliveries, and possible tariffs on imported parts may impact costs. Musk stated that battery pack availability is Tesla's main bottleneck in 2025. Tesla is prioritizing battery supply between vehicles and energy storage. From November to December, Tesla went from 250 to 480, up 92%. Since then, it's down 42%, back to around 280. But this is risk that is worth taking for long-term investors as it is up 21x over the last 10 years. So 10,000 in 2015 would be worth 210,000 in Tesla stock today. Does the volatility of Tesla stock scare you? Let me know in the comments below. Here's what got me really excited. Elon Musk stated that Tesla is on a path to become the most valuable company in the world due to self-driving technology and robotics. Tesla is going 10x on autonomy. They're not just doubling down. Tesla built a massive 50,000 GPU training cluster named Cortex at its Gigafactory in Texas. Cortex has propelled FSD with major safety and performance improvements. AI investments have reached $5 billion so far, with more planned.
That's a lot of money.
Tesla plans to launch unsupervised FSD with no driver required in Austin, Texas in June.
Tesla will launch self-driving cars in Austin by June and in several other cities by the end of the year.
Expansion to other U.S. regions are planned by the end of 2025. The Cybercab, Tesla's dedicated robotaxi vehicle, will enter volume production in 2026. I think the Cybercab robotaxi has the opportunity to completely overtake Uber and Lyft. What do you think? Let me know in the comments below. The goal is to use Optimus internally for factory automation and scale production faster than any product in Tesla's history. Musk speculated that Optimus could drive over 10 trillion in revenue in the long term. This is what everyone is missing. Tesla's energy business revenue surged 113% year over year, and it reached over 10 billion for 2024. Energy deployments hit a record 11 gigawatts, and Tesla expects at least 50% year over year growth in 2025. If you're enjoying this, please smash that like button. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
No, thank you.
That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. I saw something really cool in their debt, and I can't wait to show you.
You gonna show me the money.
Tesla has over 37 billion of cash and marketable securities, and they are net cash by over $29 billion. This gives the company a stockpile of cash to invest in the future, including self-driving cars, robotaxis, and humanoid robots. Debt is 8.2 billion, but 4.3 billion is asset-backed notes. Here's what's cool about that. They took their leases and issued debt against those leases so that they could get money back and have it fully supported by the cash flows from the leases instead of their core business. Retained earnings grew 116% in 2023 and 26% in 2024 to over $35 billion. Tesla and Amazon are the only Mag 7 stocks to not pay a dividend, which gives them more money to reinvest in the company for the long term. So what's the takeaway? Tesla has tons of cash, its debt is manageable, and it's substantially growing retained earnings. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenue minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will expand, which is what we want to see. Total revenue increased 1% from 2023 to 2024. The main reason it did not increase more was due to reduced average vehicle price and offering more attractive financing options. Margins experienced contraction in 2024. While COGS per vehicle reached an all-time low of 35,000 in Q4 2024, there was an increase in operating expenses driven by AI and other R&D projects. Net income decreased in 2024, but there's two main reasons. There was a $684 million one-time restructuring cost in 2024, and there was a $5 billion tax benefit in 2023 from deferred tax assets, causing a one-time artificial boost. So what's the takeaway? While margins have contracted recently, top-line growth remains solid and the future is looking bright. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, and financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and has grown rapidly in the last 5 years, but leveled off the last couple of years. Free cash flow has come down from 2022 to 2024. The leveling off of operating cash flows due to the restructuring and tax benefit that we just discussed. The free cash flow decline is primarily due to the increase in CapEx for AI, humanoid robots, and self-driving cars. From 2022 to 2024, Tesla generated $40.7 billion in proceeds from its invested cash. This is something we've seen with other Mag 7 companies, and it's a sign that Tesla has excess cash to invest and is generating passive income. Tesla has not needed to issue equity over the last 4 years. In addition, there is no dividend and no share repurchases. Tesla is self-sustaining and plowing its money back into the company for future growth. So what's the takeaway? Tesla is using the returns generated from its cash to invest in AI innovation, self-driving cars, and humanoid robots. So what does all this mean for the valuation of Tesla's stock? Let's cover that next. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so that you could build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above, and it's in the description.
Hey, that's cool.
As you can see on the left, we take specific line items that we projected from the 3 financial statements, and we use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity because the company doesn't stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out debt, we add cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value of about $977 billion. We divide by the current shares outstanding, we get an implied share price of about $304 per share. Compared to the current close of $279, we get an 8% discount, which is a hold rating. On Wall Street, if a stock is trading at greater than 20% discount, it's considered a buy because it provides a margin of safety. So what does Wall Street have to say about Tesla stock, and how can that impact your portfolio?
I'm all ears.
While analysts recognize the challenges of the electric vehicle sector, they see the long-term potential of self-driving cars, AI advancements, and robotics propelling the stock to an exciting future. Goldman Sachs has a hold rating on the stock, and they lowered their target price from $345 to $320. They maintained a neutral stance, citing weaker than expected demand in Europe and increased competition in China. They also noted that Tesla's brand favorability scores have declined, potentially impacting sales. Morgan Stanley has an overweight buy rating in the stock with a target of 430. Morgan Stanley reinstated Tesla as their top pick in the U.S. auto sector, emphasizing the company's advancements in artificial intelligence and robotics. They believe these technologies could significantly boost Tesla's market value. Legendary tech investor Dan Ives from Wedbush Securities has a buy rating on the stock and the highest valuation across Wall Street for Tesla at $550. Ives is focusing on Tesla's potential in its upcoming mass market vehicle and its self-driving ambitions. He believes these factors could drive significant growth for the company.
Wow, that's ambitious.
This is a screenshot of CapIQ. I use it a ton for my analyses. 42 analysts cover Tesla on Wall Street. The target price ranges from a low of 135, which is a 52% decrease, to a high of 550, which is a 97% increase. The upside outweighs the downside by almost 1.9 times, 97 to 52. Hedge funds typically look for 2 times or greater. The median is 376.50, which is a 35% increase. The overall rating on a scale of 1 to 5 is 2.74, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice.
That being said, I do own a position in Tesla. I am a big believer in the company, and it's currently the third largest position in my portfolio at a weight of 10.3%. Now, if you decide to buy Tesla, you need to get in at a good entry point, which I'll reveal shortly. Tesla is rolling out unsupervised full self-driving in June 2025, with the Robotaxi Cybercab business launching in 2026. If successful, this could create a massive new revenue stream. Tesla is investing heavily in AI, including a massive Cortex training cluster and its Optimus humanoid robot, which could eventually become a $10 trillion business, according to Elon Musk. A cheaper Tesla EV is launching in 2025, which could expand Tesla's customer base and drive higher sales. Tesla is opening its supercharger network to other automakers, creating a new revenue stream from charging fees. Tesla hit a 52-week high of 488.54 in mid-December, and it's down almost 43% since then. Tesla is a core foundational investment that you must hold for the long term to realize its full potential. If you choose to invest in Tesla, do it for the belief in self-driving cars, robotaxis, and humanoid robots. Do not invest simply for the electric vehicle business, because that's not where the long-term value is. My model shows a value of 304, which is an 8% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Tesla's a hold at current levels, but I would be looking to buy below 255 in the 250 to 255 range.
Thanks for the advice.
If you like this and want to see another in-depth stock valuation, check out my Amazon video here or my Alphabet video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.